think that's 11 o'clock. The recording has just started, so we will kick off there. Thank you once again for joining us for the second of this two-part mini-series presented by myself, who's a director of Whitley Stimpson, and Angus Aston, who is a director and senior financial planner with Wise Investments. We're hoping that the majority of you, if not all, managed to see the first instalment of this 2 weeks ago. If you didn't, then it's available on our YouTube channel, and our marketing team will also include the link to the first webinar when they circulate the details for this recording later on this week. A lot has changed in the world in a very short space of time, and since we did the first webinar, and we'd just like to say that our thoughts are with all of those who are affected by the ongoing troubles. A little bit of housekeeping. The follow the same format as the first webinar. So Angus and I will run through the presentation and the various slides. There will then be a Q&A session at the end. If you have any questions as we go through, please do write these in the Q&A box, and you should have a taskbar. It's usually located in the middle of the screen towards the bottom. There is a Q&A button on there. If you click on that, it opens a questions box, and you can type your questions. No heckling, please. We will try and work our way through all of the questions at the end. If there's anything, given the nature of what we're talking about and inheritance tax, if there's anything that we deem to be very personal to your situation, then we will pick this up with you separately and answer it offline rather than answering it in the general forum. But we'll do our best to cover everything that we can. So I think that then leads me into handing over to Angus to say a few words about Wise Investment.
Thank you, Ian. Good morning, everybody. So very briefly, Wise Investment has been in and around Chipping Norton for almost 30 years. I myself have been with the firm for 18 of those 13 years. And I think the key points are we are an independent employee-owned business, and we're very happy to be that way. The thing that keeps us up, gets us up in the morning is to be looking after our clients on a long-term basis and getting to know them very well. The main areas that we help them with are essentially investing sums of money, building up investments and pensions for retirement, and advising on how to generate income in retirement. And alongside that, we will do things like setting up protection plans as required, and the subject of today's seminar, inheritance tax planning. So that's us, and I think we can hear more about Whitley Stimpson as well, Ian.
Thanks, Angus. So Whitley Stimpson, we've been going for slightly longer. We were founded originally in Banbury in 1931. We are a top 100 firm of accountancy practice. We provide a really wide range of services and really mirror the ethos that Angus has just outlined for Wise. It's very much about getting to know our clients, building long-term relationships, and being with you right the way through your financial journey, whatever that looks like. We now, or over the last 15 years, we have expanded away from just having an office in Banbury, and now have 4 offices covering the Thames Valley, with High Wycombe, Bicester and Whitney as well. We employ just under 100 staff, and as I say, offer not just the compliance services that you would expect, accounts preparation, tax returns, etc., but also a full range of auditing, advisory, tax planning, structuring, and even specialist advice in certain sectors. Full details of that are on the website, and I think the link again will be shown at the end. We have to keep the various compliance teams happy, have to cover the legal points. So the contents of this presentation are Angus and I's personal views. It should not be construed as any form of financial or investment advice, given the generic nature and the fact that nothing is tailored to your specific circumstances. All information is based on our understanding of the current law and practice, which it says may be subject to change in the future, will almost certainly change in the future. And past performance is not an indication of future performance. So again, any investments that you make can go down as well as up, and your capital might be at risk. So as this is the second part, we thought it would be useful to give you a quick recap as to where we are and what we'd covered in webinar 1. So you will remember that we are looking at here the fictional Montagu family, which for years has been headed up by husband and wife Frank and Angela, who are happily married. They had 2 children, Ben and Caroline, who again have both been married and are both, very successful with their careers. And both Ben and Caroline have had 1 child each. Caroline's son is called David and is 17, fast approaching university. And Ben's daughter is Emily, going on 31. He's got the teenage years to come, and obviously a few years younger than David. Everything was going very, very well for the family, and then unfortunately Frank passed away at the not so old age of just 70. So it left Angela. Frank had tended to take the lead on the family finances, and it left Angela with a number of questions and considerations, of which the primary concern for Angela was actually how she would generate the income and have enough income to maintain her current lifestyle. So we considered various options in webinar 1, and I think this is where I pass over to Angus to run you through the option we've concluded on.
Thanks, Ian. So very briefly, of all the multiple ways that we could meet Angela's income target of 40,000 a year, here's what we plumped for the purposes of illustration. She has guaranteed pensions in the form of the state and Frank's old occupational pension scheme, widow's benefit. Total of those 18,000 a year. Her stocks and shares ISA is invested to produce about 3.5%, which is achievable in current markets. That's tax-free, so that gives you 8,750. A decision is made to purchase a smallish annuity to provide more secure income towards meeting her sort of basic living costs, and 3,000 a year involves handing over £67,000 of Frank's pension. And you might recall that income is also tax-free because Frank died before the age of 75. See the previous webinar for the technicalities of that in more detail. Now, a decision, and a very flexible decision, has been made to draw fairly heavily on Frank's pension because it's tax-free at the moment. Now, the figure there is more than she actually needs, so we've produced a surplus. And the other thing that's happened is that we've left the ISA that used to belong to Frank has now been transferred over to Angela untouched, so it's not at the moment needed to provide income for Angela. So there's something else that we can do with that towards inheritance tax. And so roll on the next slide, I think.
Absolutely. So we'd summarised where Angela's thoughts were in the first webinar, which, as I said, were largely around income. We've now moved on a little bit here, and Angela would like to start being able to help the family with various things. So we've got Emily and David. David clearly just approaching university age. Emily that bit younger. Caroline and Mark are doing some work for their house. And she still wants to, Angela's still relatively young. She's 72 and she still likes to travel. This is assuming a situation BC, before COVID, when travel was much easier. And she's also, in the back of her mind, has got concerns about the rising level of care fees that she reads about in the paper on a seemingly weekly basis. But what we're going to do is start off today with actually considering what Angela's current inheritance tax position looks like, which leads us into the next slide. And you will see here we've got a brief summary of Angela's assets. Those shown in the top half of the box are subject to inheritance tax, or would be if Angela were to pass away. And those in the bottom half are exempt, so pensions are outside of the scope of inheritance tax.
But as we looked at last time, they're not, at the moment, if Angela died, they would be tax-free for the recipients because she's under 75, but it won't be that long before they become taxable, potentially. So while they may be exempt from inheritance tax, it doesn't mean that they're tax-free forever, unfortunately. No,
that's a really good point. And I think the key takeaway from last week was also about making sure your nominations were correct. So, and again, anybody who hasn't seen it, I would say watch the previous webinar to pick up on that as well. Angela's current inheritance tax liability, as we've said there, based on her house, her cash savings, and her various investments, amounts to £240,000, which is a larger figure than Angela was expecting. Very briefly, the way that's calculated, you will see there we've got 600,000 multiplied by the current rate of inheritance tax, which is 40%. The difference between Angela's taxable assets at 1.6 million and the amount that actually is subject to inheritance tax of 600,000 relates to her various nil rate bands that are available to Angela. So I think most people now are comfortable with the standard nil rate band, which is £325,000 and has been frozen at that level for some time. Again, it's an area of consternation to a lot of us that it hasn't been increased, even with inflation, but it has been stuck at that level for some time. And the way that works is that everybody is entitled to a nil rate band of £325,000 upon passing, which gets adjusted down for any gifts that you've made within 7 years prior to your death. If your spouse didn't use their nil rate band, either because they didn't really have any assets, or more commonly because they passed everything or left everything to you as the surviving spouse, then their nil rate band also transfers across to you as well to be able to be used. So it's quite common for us to see that the surviving spouse has a nil rate band available, a standard nil rate band of 650,000. The government decided in their infinite wisdom 5 years ago to add another layer of complication to this, which was the introduction of a residential nil rate band, or the residence nil rate band. This was introduced on the 6th of April 17, so for the 17-18 tax year, and was phased in over a number of years. And I'm not going to go into details on those phasings, but we are now at the maximum allowance of £175,000 for each individual. This applies when you are leaving your home to your the exact wording is direct lineal descendants, so children, grandchildren, great-grandchildren.
Stepchildren as well.
Yes, stepchildren are also specifically included. And actually, one of the main funnies with this is that even if your spouse had passed away before the 6th of April 17, actually you can still claim their nil rate band, their residence nil rate band, in the same way as the standard nil rate band, even though these rules weren't in place. So the idea is that when you combine the 325,000 with this additional 175,000, everybody now has £500,000 inheritance tax free as a starting point. And if you're able to benefit from your spouses as a married couple, then you've potentially got £1 million there tax free on the second passing. A very good point that Angus noted to me when we were having a quick run through this morning is that actually the residential nil rate band, and only that one, does get tapered away if your estate is worth more than £2 million. And I must stress on this point, because I advise a lot of farmers and landowners, this is the gross value of your estate before any reliefs. So if you do benefit from a relief, such as agricultural property relief or business property relief, you look at the value of the estate before those are applied, not after. So again, for a lot of my farming clients, they do get caught by this because of the way that land values currently are. And the way that works is that for every £2 above 2 million that you lose £1 of the allowance. So once you get to 2.35 million, it's disappeared, it's gone.
Yeah, except if it's a married couple and you're the surviving spouse, you've got two residence nil rate bands, it's actually then 2.7 million. The rules are, when you start to dig into the detail, it gets fiendishly complex. So if you are in a position where your estate, your assets are more than 2 million, then it's worth taking advice, I might say, because it can get quite knotty.
Absolutely. So that's really a fairly whistle-stop tour as to how Angela's current inheritance tax liability is calculated, and that then leads us on nicely to the interesting points about what we can actually do to try and mitigate this in some way. If I start with what I would call the easy annual housekeeping for people to consider, and then Angus takes the nice big ticket items. So what I refer to here is usual IHT planning. Everybody can give away £3,000 a year to either one or spread across a variety of people, as well as small gifts for Christmases and birthdays and weddings, etc., if you're giving to your children. And those are immediately free of inheritance tax. So, as I say, you can give away £3,000 a year, and from the day you give it away, that is free from inheritance tax. If you weren't aware of this, and so you haven't done this gift in the previous tax year, then actually you can use one previous tax year's allowance as well. So you might be able to give away £6,000 in the first period, and then from there on it becomes £3,000 a year. I've said here, consider gifts out of income. I'm going to really leave it there because we come on to look at that in more detail in a few minutes' time.
Yeah, so those are sort of, as Ian says, kind of general inheritance tax housekeeping. It's sort of keeping a lid on the liability. If you want to do more substantive things, the sort of next obvious port of call is simply to give larger sums of money to your family. The trade-off with that is that once it's given, you can't have it back. The rules, there's a special rule, gift with reservation of benefit, that essentially says if you reserve the right to have some benefit or to have the money back at some point, then it's not a gift. And that does lead to some tension between keeping enough for yourself in the long run and helping your family, reducing the liability now. Now, with that in mind, there are some more, let's be honest, less straightforward, but nevertheless well-established investment schemes that you can take up that try and meet these complexities. So there are trust-based arrangements where essentially you create a trust, you become a trustee, you appoint trustees and beneficiaries, where you make a capital gift into that trust, but you are able to reserve the right to a regular monthly or quarterly or annual payment from the trust fund. A most common type is a discounted gift trust. And that sort of strikes this balance between putting money outside the estate, but also still providing you with income. Now, there isn't the scope probably in this webinar to go into the technicalities of that, but it's well established and it works. If you don't want to give away capital, and trust-based schemes can be relatively complicated and administrative heavy, there are certain types of investments that qualify for what used to be called business property relief, is now called business relief, where if you've owned the shares for 2 years or more, then they will have a 0 rate for inheritance tax. It's not automatic, it needs to be claimed, you need to list the assets on the inheritance tax return. But again, these are things that have been running for quite a long time and have been seen to work. So a common example is the junior investment market. So there's the main stock market, and then there's what's called the AIM, the alternative investment market. And that shares listed on that qualify for this relief, provided they are trading companies, not just investment companies or companies that just own property, for example. So there are many services run by investment managers where they buy and run and manage for you a portfolio of AIM shares. So that although there is investment risk involved, and actually maybe it's relatively high risk in terms of the types of investments you can undertake, the benefit is, one, it works in 2 years rather than gifts working in 7, but also if you want the money back, you can simply sell the shares because it still belongs to you. There's a question come straight up: do unit trusts qualify for business property relief? No, they don't. Is the short answer. Even if the unit trust itself is investing in AIM shares, the ownership of a unit trust won't be exempt. So that's a sort of brief overview of these types of schemes. If you invest in an unlisted company, that should also qualify for business relief. And there are schemes where you buy the shares of an unlisted company and it does things that are relatively consistent and relatively low risk in terms of business risk. So, for example, they might own, this is quite common now, they might own solar energy generation capacity or wind farms because these have quite consistent income streams. Not without risk entirely, but relatively steady. So that's an alternative to investing in AIM shares, which can be quite volatile. So there's a brief overview. And there's one other thing.
The charitable legacies
to look at, which is giving money to charity. Ian, there's some detail on that, which is worth looking into, I think.
Yeah, thanks, Angus. The charitable legacies. So this is there's 2.2 parts to this really. If you leave a legacy in your will to a registered charity, then that legacy there is automatically exempt from inheritance tax. So if you leave £20,000 to the RSPCA as an example, other charities are available. Then that immediately becomes free from inheritance tax. But actually, the larger saving can be derived if you end up leaving 10% or more of your estate to a registered charity. Then it reduces the rate of inheritance tax which applies to the residual estate from 40% to 36%. So they offer a further sort of 10% saving on the rate of inheritance tax there. So it's just, again, it's one that's worth bearing in mind. And if you add up your charitable legacies and they're very close to the 10%, you might decide just to increase them to benefit from that additional saving.
Well, yes, and I think this is charitable legacies in your will specifically, and this is where a suitably qualified solicitor or will writer should come in to draft your wills appropriately, so that you essentially saying that 10% of your estate value, whatever it is going to charity, rather than specifying an amount because your estate value might change.
Absolutely.
So that's if you're looking at that's definitely something worth taking advice on as well.
Absolutely. No, you're right. And there are a couple of points as we worked through this, Angus, where we did say actually if we were doing a wider seminar on this, having an estates lawyer or solicitor would be very useful, I think, for some of these.
Yes.
So that then leads us on, as I mentioned, to look in a bit more detail at what we call gifts made out of, or regular gifts made out of income. And we thought we would look at this in more detail because it's something that's widely discussed, but actually in practice, not as widely used as you might expect. So the general premise here is, as Angus said, if you have surplus income being derived each year that's just going into your bank account or your stocks and shares savings, and you do nothing with that, then effectively you're contributing to an inheritance tax liability, because each year your estate will increase in value and that would be subject to inheritance tax. So what you can do is, if you have got surplus income, you can gift that income each year or part of that income, and it's then free from inheritance tax. So we don't have to survive the 7 years as you do with larger capital gifts, and it effectively stops your inheritance tax getting worse or significantly mitigates it. But actually, the practicalities of doing this are slightly more involved than I've perhaps just made it sound. I think that's fair, isn't it, Angus?
Yes, I mean, it's simple in principle, but there's quite a lot of admin in practice. So, I mean, well, shall I delve into it?
Absolutely, yeah.
What you can see here is an extract from the actual inheritance tax form 103, which is where you declare gifts that have been made in the last 7 years and claim this exemption that the gifts have been made out of surplus income. So it's not automatic. You need to keep records, and this tells you what the revenue will be looking for your executors to submit. So details of your income in all of the last 7 tax years, because this exemption doesn't matter for gifts made more than 7 years ago because they're exempt anyway. you'll notice there's 8 columns because the anniversary of the gifts might fall in the middle of a tax year, so you've got to provide information for that tax year and the latest one. You will notice you need to put gross figures, and you also need to include some non-taxable income, such as income from ISAs, which may not be on your tax return. So you need to make sure you kind of keep track of everything that's coming in, and also don't confuse capital receipts with income, even though you regard them as income. If it's a chunk of money, if it's some money someone's giving to you, for example, that's not income of yours. That's just a gift. And then there's the breakdown of spending, which you can see the itemized columns there. Interestingly, they've put nursing home fees as one option. Now, I think if you're in the realm of paying nursing home fees, you probably don't have any surplus income unless you have a particularly fantastic pension. But there we are. So that's the sort of summary they're looking for. And other is a basket of pretty much anything. So you'll need to keep probably your bank statements, and if you use a credit card, etc., you need to keep those so that your executors can fill in this form properly.
And this is trying to give away gifts in excess of the standard £3,000 a year, isn't it, Angus? So yeah. If you're giving away the £3,000 a year, which is automatically free from inheritance tax, and you don't want to do any more, then you don't need to worry. If you're in a position where you could give away more than the 3,000, then quite often the consideration really is, do I want to go through this administration process and keep all of these records? Is it worth it? And whilst there's no right or wrong answer, I think Angus and I are generally fairly aligned in that if you're looking to give away, if you've got surplus income of sort of £10,000 a year or more, given that the inheritance tax saving is 40% of that, and you might be able to do this for a number of years, it does quite quickly generate quite a potential inheritance tax saving, doesn't it, Angus? Yeah.
So, well, in our example, 7,000 a year over, say, 10 years is, as you'll see, 70,000, 40% of that, £28,000. So you might say that it's worth the time at that level if you can get organised about it. Yeah. But there we are. I mean, I think we've made the point, haven't we, that
absolutely.
It requires dedication in order to claim this exemption properly.
So that then leads us on to Angela had said from the outset that once she'd sort of got herself financially stable herself, she wanted to be able to help her family and actually help her family while she was alive and could see them enjoy it. And that is a very common thing that I certainly come across when talking to clients, is that they want to actually see the gifts being used. So we're going to start, I think, with David and Emily over on the right-hand side of the screen there. We've already explained that Angela has, surplus income of circa £7,000 a year, and she's decided she would like to make some regular gifts out of income. So that decision has been made. She would like to make those to David and Emily, and she'd like to treat them both equally. So David, they're at slightly different stages of life in that David is soon to start university, A-level results pending, and so he would look to probably spend the money that he was receiving from Angela on either accommodation or tuition fees. But again, just talking to Angus, it might be prudent for him to consider, even with a small amount, opening a lifetime ISA whilst they're available, Angus.
Yeah, so, well, he needs to be 18 before he can do so, but if, as long as he's got his living costs, etc., covered at university, as it might be £3,500 a year he's going to maybe get from his grandmother. A lifetime ISA is a long-term savings plan where the government gives you a 25% bonus of anything you put in up to the annual allowance of £4,000 a year. So supposing he manages to scrape together £4,000 a year, then that will generate a bonus of another £1,000. Now there are strings attached to this, sort of basic rules. You have to be between the age of 18 and 40 to open it, and once open, you can continue saving in it up until the age of 50. To retain that government bonus, you have to use the money towards a deposit for your first home, which has a maximum purchase price of 250,000 or 450,000 if it's in Greater London. Failing that, you are not allowed to touch it until you're 60. At that point, you can withdraw it tax-free, unencumbered under the rules as they are at the moment. If you need to withdraw it for any other purpose, then you would be penalised 25%, which, if you do the sums, is actually more than the government bonus, because it's 25% of the now gross value. So on £5,000, it'd be £1,250. The only other way that you can get money out tax-free is by dying or having a terminal illness. So you need to undertake it with the expectation that you're going to use it for a property deposit. Should we look at the options for Emily?
Yeah, I think
who's only 11, so she's not going to qualify for a lifetime ISA anytime soon. But her parents, if they haven't already, can open for her a junior ISA with an annual contribution allowance of up to £9,000. And Angela can pay directly into that if she wishes, and then it would, whatever's there will convert to a grown-up standard ISA for Emily when she's 18.
And that's the key here. And anyone who's attended any of the budget seminars that I've presented will know that I give the same warning each year, that with junior ISAs, when the child turns 18, they do gain full access to this account. You can't restrict that or hide it from them. In this situation, perhaps not quite so severe, but as Angus mentioned, the annual allowance is £9,000 a year, which, if you were to do for the full 18 years of their childhood with some reasonable growth, might give a very substantial pot of money that they are entitled to on their 18th birthday. And I'm not sure that we're all at our most sensible point at 18 years old. So it's just something to be aware of.
Okay, there's a comment there. Someone seems to have lost sound. I don't know if that can be picked up, but I can certainly hear you myself, Ian. Okay.
So
shall we move on to the capital?
I was going to say, that covers David and Emily, doesn't it? So it then just leaves the bigger capital gifts to Caroline and Mark. So I think you were going to just touch upon.
Yes. So Angela, wanting to help her daughter with work to the house, she'd also like to treat her other son equally. And she has options as to how she's going to provide this 50,000, and that's just a sort of way up. Does it come from cash? How much return is she missing out on? She could take it from her own ISA, or even from a tax-free lump sum from her pension, or a chunk from Frank's pension. That would need closer examination to make a sort of absolute decision. But for the purposes of this, we've assumed we've taken it from her cash savings, as that's the simplest thing to do. Key point to note is that I think you can move on to the next slide there. The 7-year rule applies to those those gifts, as Ian touched on earlier, she may be able to ignore the first £6,000 worth using 2 lots of the £3,000 allowance. But one way or another, two chunks of 50,000. If she survives 7 years, they're going to save a total of £40,000 in inheritance tax.
And we have had a question come in,
sorry.
which is we've had a question come in, and that's quite a convenient time to answer it.
Okay.
The 7-year clock starts rolling from the date of the gift, not
Yes.
the end of the tax year in which it's given. So it's
correct. Yeah.
You look solely at the actual date that the gift is made.
That's correct. Yeah. So, I mean, if you want to be absolutely belt and braces and make sure your children don't suffer the effects of the inheritance tax, you could take out an insurance policy for 7 years for £40,000. Note that sometimes people might think that actually the gift or the tax on those gifts of that size would be reduced by tapering relief over time. That's not the case in this example, because that only applies where the total gift is greater than the standard nil rate band of £325,000, because these gifts are deemed actually not to be taxable themselves because they would use part of the nil rate band. However, the effect is that everything else suffers another £40,000 of inheritance tax. I hope that makes sense. Please do ask a question for clarity if you would like it. Just conscious of time, actually. So supposing various decisions are made, those capital gifts, Angela decides to undertake the administrative burden of keeping the information for gifts out of income. And supposing she survives for 10 years, she's given away £7,000 a year for that period, and takes the plunge and moves £250,000. The ISA that used to belong to Frank into an AIM portfolio service, which in time, if it keeps that value of 250,000, it'll save £100,000 of inheritance tax. If actually the value grows, the entire amount is still exempt. Similarly, if the value falls, which it might, then, well, the saving is 40% of whatever it's worth on her death.
You can retain the ISA status, can't you?
Correct. That's right. AIM question mark has just popped up. Alternative investment market. So their shares listed on the junior stock market in the UK, and there are some other qualification requirements for the relief, but it's assumed that those are met when you invest through an AIM portfolio service. So in this example, we're potentially saving over time, getting on for £170,000 of inheritance tax. Yeah, so of all the many things that could be done, this is what we've plumped for. So we can then look at how this, what is Angela's position then following that, and what might she do about care?
Yeah, absolutely. So having made those gifts and committed to as Angus said, the administration side of making regular gifts out of income, Angela is still actually left with her house, her own stocks and shares ISA, which, as we talked about, she's generating sort of 3.5% income from, which is feasible at the moment. And then she has reduced her cash savings to make the 2 gifts to Ben and Caroline. But given that the interest rate in this example was, I think, 0.5%, which isn't uncommon, that hasn't really sort of put any sort of dent or damage onto Angela's annual income. So she's managed to give away some significant sums without impeding her income position. She's now clearly at this sort of junction. She's, as I've said, she's considering the care position, and what she's got left, as to how she would fund that. and care costs. I mean, we've put there that in Oxfordshire we're seeing sort of reasonable care home fees being between £1,200 and £1,500 a week. So over a year, the costs do add up, and Angela is comfortable that she's still got sufficient assets left that should she need to go into care, she would be able to pay those fees. We've made reference to the new cap on care costs as well, which is due to be introduced from 2023 onwards, although many of us will start contributing more national insurance this year to start to fund it. But actually, having read through the discussion document that the government put out, the key point to note is that the cap of £86,000 only applies to care costs. It does not apply to accommodation. So what we think we will see in practice is that care homes will start to, if you see the care home invoice, it will be broken down between accommodation costs and care costs, and only the care costs contribute towards the 86,000 cap. Accommodation costs are still uncapped, and if you were to need care home services for long enough, you would continue to pay those even once you've gone past the 86,000. I don't. There are various questions that have come in, and I'm also conscious of time. There are specific downsizing or care provisions linked to the residential nil rate band, and I think it's become quite clear from the questions that have been raised and points we've discussed there. We could probably do another series on the residential nil rate band quite easily. Such are the complexities within it. But broadly speaking, if you sold your home on or after the 8th of July 2015, which is when the residence nil rate band was first conceived, I believe, then to either release money for care or to move into a care home, then you can claim what they call the downsizing additional allowance, which broadly is you calculate your inheritance tax in the normal way, and you look at what residence nil rate band you would have been entitled to based on your estate. And it's really just looking at, okay, you don't own the property anymore, but are you still giving sums to your direct descendants? And if you are, how does that compare to the residence nil rate band? And if you're leaving more than the residential nil rate band to direct descendants, you may still be qualify for the full allowance.
So in this example, supposing Angela needs to sell the house having moved into a care home, then her executors would still be able to claim the residence nil rate bands, because there's a sort of trail of evidence saying she had to sell the house to help pay for the care, and so they would still qualify for the extra nil rate band.
Absolutely. And I think the only other thing that we were going to mention briefly, although it's well outside of my skill set, something called an immediate needs annuity, Angus.
Yes. So, as part of the decision, if Angela is needing care, whether it's at home or in a residential care home, she could consider buying an immediate needs annuity, which is essentially designed to help pay for care costs and provide a secure, fairly high level of income in order to do so. So typically the return might be 20% a year. So if you take, for example, that stocks and shares ISA of 250,000 and turn that into an immediate needs annuity, it might pay, for example, 50,000 a year, and that would be tax-free if paid directly to the care provider or the care home. There are obviously trade-offs there, because you're not going to see the capital again. The rates are quite high because usually people's life expectancy at that stage is not very long. and of course that leaves potentially less money in the pot for Angela's family. On the other hand, if you've knocked 250,000 off that total, then suddenly the estate value is $1 million and there's no inheritance tax at all. Yeah, that's something that can be looked at. I know as well that there was a question last week about equity release, which could be used to fund initial gifts or capital gifts to the children potentially. It's maybe unlikely to be able to be used to fund care costs. I have seen provisions in equity release contracts that say if the homeowner moves into a care home, then their expectation is that the house would be sold and the debt repaid. So that may mean it's not an option to cover care costs. So what we've left Angela with is a fair bit of flexibility should she need care. And again, there will be kind of important decisions to be made at that point. But she's not going to be left short, I don't think.
No, and I think that's the thing, is we've left Angela with flexibility and balance, and that's what we were trying to demonstrate, is that with all of these considerations and discussions, you try to come out at a balanced position, ensuring that Angela has enough to continue to live on and fund the lifestyle, whatever that might be, whilst also mitigating the inheritance tax problem. Yeah. Hopefully we've shown how that can be achieved in this sort of fictional example.
Yeah, I think the key point is that there's no one solution or set of solutions that is best, and the other thing to think of it is seems to me a process that you kind of keep under review over time, and maybe incrementally do more and more substantive things towards inheritance tax planning, rather than it just being a kind of one-off, right, done, dusted, we can put that away and forget about it now. And I guess the same applies to provision of care costs as well.
Absolutely. So I think that wraps up our slides, leaves us with just over 5 minutes to cover some of the questions and answers. If I kick off, Angus, we've had one: do Wise Investment run an AIM portfolio service?
We do not, because it's actually you need quite a significant sort of equity individual company research team. So these tend to be offered by some of the larger stockbrokers and so on. We maintain a list of the companies offering the service, and we can recommend, we can advise on it and recommend a particular provider to suit what you're trying to achieve. And that's something that we do fairly commonly.
Perfect. We've had a question: can the 3,000 IHT free annual gifts come from capital, or must they be from income? No, they can come from capital or income.
Yeah. So
you can sell shares or whatever you might want to do and make those gifts. There's no problem with that. I think you've already answered: do unit trusts qualify for BPR AIM?
They do not, unfortunately.
Perfect.
If only it were that simple.
Indeed. So a question here on the nil rate, or residence nil rate band. Does the 2 million limit, i.e. when you start to lose the residence nil rate band, include the non-taxable assets? And the person's actually put i.e. pensions and ISAs. Well, ISAs are unfortunately, they're always subject to inheritance tax. They're income tax free and capital gains tax free, but they are subject to inheritance tax. So ISAs are included, pensions are not. So pensions do not contribute.
You can ignore the value of pensions for the purposes of the residence nil rate band.
Absolutely.
I think, as Ian said, there's a lot that you could talk about the residence nil rate band and what happens when you go over the 2 million allowance. I hope the question about how the residence nil rate band works has been slightly answered here.
That's linked to the question above, Angus. It's just the question above was missing the word work.
Oh, I beg your pardon.
Yeah, so it's we're just looking at here if you leave some of the estate to your direct lineal descendants and some to other relatives or even remoter issue, friends, etc., how does that interact with the residence nil rate band? What we're looking at is we're comparing the value that has been left to direct descendants and the value of the residence nil rate band.
And the value of the home.
And the value of the home. So if I use an example where the home is worth, say, 500,000, and they give that's the only asset, 400,000 goes to direct descendants and 100,000 goes elsewhere, then they benefit from the full residence nil rate band because you apply that first and the value of the home is worth more than the nil rate band. So there's the IHT saving, and then there's no impact of making gifts to other relatives or friends. If the gifts to others start to become significant and perhaps roles are reversed and they'd only left 100,000 to direct descendants, then the nil rate band would be tapered in that scenario.
Well, it would be fixed at that 100,000, wouldn't it? Yeah. So I mean, if we're boiling down to specific situations and what your individual plans are, I think we'd probably have to look at those offline, because when you start to kind of unpick the rules, as we said earlier, that it can get quite complicated, and I find myself having to go back to the books just to double check.
Absolutely. One that I will try to answer quickly: what happens after age 75 inheritance tax wise? In terms of the actual inheritance tax calculation, there's no differential in how that's done or treated, whether you're under 75 or over 75. The big change and the big difference is that if you are leaving pensions to your beneficiaries, children, friends, whatever, and you've made the correct nominations as Angus outlined in webinar 1, if you pass away before the age of 75, then those pensions are income tax free for the beneficiary. If you pass away after the age of 75, then they are subject to income tax at the beneficiary's marginal income tax rate.
That's right. Yeah. There's, just picking up on a couple of comments, a query about the lifetime ISA property cost limit. I think I'd said that it was 250 outside London, and that's just being queried. It might be 450,000 altogether. I'll tell you what, I will take that away and have a look again just to make sure that I've got that right, and if I made a mistake there, I apologize. If the person who's asked that could maybe provide their details, then we can sort of answer directly.
I think the bottom question might be one for you to take offline, Angus. That looks quite technical to me.
About the discounted gift trust and offshore bonds. Yeah, I mean, that is quite technical. An offshore bond is essentially a tax wrapper that's available to UK investors that has no income or capital gains tax while the investment remains within the bond, and there's sort of a cap on how much you can withdraw every year. There's mention in the question of a reversionary trust, which I think is probably better if we speak kind of directly, just to make sure our understanding of what that is tallies. So if we can take that up separately, that would be great.
I think the last one that I'll answer is what if you miss the gift 1 year? I'm not sure whether this relates to regular gifts out of income or the capital or your standard £3,000 gift. If you miss a £3,000 gift, i.e. don't do that for a year, as I say, you can then do double the following tax year if needs be. So that one's quite straightforward.
In terms of the regular income, actually, that raises a good question. Is is the gift no longer regular if you skip a year?
Yes.
So that is.
It becomes a matter of really why and what's happened there, and depends on the individual circumstances, and that's why documenting all of this is so so important.
What is true is that the gifts don't have to be the same amount every year; they can vary.
Yeah.
So there's been a case law where this has been tested, where the amounts were wildly different, but there were amounts given every year. And we're talking about quite significant sums because the individual's income was very high. But it was the fact that gifts were made and were affordable within the income. They didn't have to be consistent. So there's them being zero might be problematic, I suppose. And I think it's something that would have to be sort of tested in case law, probably. I think if, unless you're talking about very large sums, it might be something that you could, that would be okay. But I suppose if you had a pattern of 3 years on, 1 year off, and then another 3 years on, they might be looked at in separate blocks, for example. I'm slightly guessing here because knowing the mind of HMRC can be quite difficult.
There's one final one which I think might be for you, Angus.
Read away.
Do low carbon hub shares in solar arrays get exempted from IHT or qualify for business relief?
On the spot, the short answer is I don't know, but I'll take that away and investigate, and if that's okay, can I come back to you on that one?
Perfect. So that has then finished all of the questions that we had there. If anybody has anything else that they'd like to ask offline or separately, or even just something you think of later on this afternoon, when I'm sure you'll be thinking about this presentation some more, then I have just put both of mine and Angus's email addresses on the screen, and they will be available in the material circulated by email later on as well. Please do reach out to us. We'd be delighted to hear from you, and we'll do our best to help. So I think all that remains is for me to say thank you very much for attending once again, and we look forward to seeing you in the future on future webinars.
Thank you very much indeed, everybody.